Hello and welcome to today's investment coffee break. Now, typically this time of year is the perfect time to take stock and really look ahead to 2024. And to help me do that today, I'm joined by Guy Foster, our chief strategist based in our London head office. Guy, how do we see this year unfolding?
Well, in a sense, it's quite similar to last year. And I suppose the encouraging thing about that would be that last year ended up being quite a good one, certainly from a stock market perspective. Um, and I suppose the thing to just be a bit cautious about, though, is that both of these years have been years in which we've had relatively elevated recession risks. So recessions are things that don't happen very often, thankfully. But when they do happen, they're typically some of the more challenging times for investment returns. And I want to just give an indication of why we do still see those recession risks just being somewhat elevated at the moment. And actually this graph should make the point. So a cycle stretches from one recession to the next. The recessions here are the vertical grey bars. And in order to ascertain where you might be within the business cycle that stretches between those two recessions, we can use various indicators. So one of them is how much unemployment is there. Now, immediately before a recession, there'll be hardly any, because actually that descent into recession is a reflection of the fact that unemployment goes up quite high. So perversely, you tend to be a bit more worried when unemployment is low than when it's high. And typically at different times that there's different amounts of unemployment that the economy can suffer. That's what this dark blue line is trying to reflect. When it dips below the zero mark, then the recession risks become particularly elevated. Unfortunately, that requires the reliance on economists' estimates of how much spare capacity there is in the economy. I never feel very comfortable relying on economists' estimates because they're not very reliable. But what we can do is we can see we can see an indicator that is observable within the market, which is the shape of the yield curve, and that's shown by the orange line on this graph. And I think the fact that both of these are below zero would make you feel a bit anxious about recession risks. The fact that they're both tracking back towards zero is hopefully a sign that those risks are beginning to ebb.
Okay. So it doesn't sound overly encouraging, but it sounds as though we've perhaps turned a corner there. Should we be selling investments?
Well, obviously, we said recession risks were elevated last year. We said they're still somewhat elevated now. Last year, as I say, turned out to be a year in which actually the economists were all wrong and there wasn't any recession. So hopefully the same will apply this year. But you might wonder why people find it so difficult to forecast recessions, and that's because even though we're doing a sort of year ahead guide at the moment, we know there are things that will happen during this year that we can't predict. Now, one of those things, or one of the unknowns, I think, is the oil price. If the oil price tends to be one of the more volatile indicators in the market, and when it rises sharply, it will eat into your disposable income. It will eat into my disposable income, and it will increase the costs of firms as well. So actually, it has a really big impact on demand when the oil price goes up, and particularly when it goes up sharply. If that happens at a time when these recession risks are elevated, that is often going to be the catalyst to actually have a recession. Wow. It didn't really last year. Let's hope it doesn't happen again this year. The obvious thing to be looking out for on that front is, of course, disruption or conflict in oil-producing regions, like obviously the Middle East, where there has been some conflict, and we see Houthi rebels antagonizing shipping through the Red Sea even now. So that's clearly something to be a little bit concerned about. But so far, the oil price has been pretty benign during that period, and therefore, it's ended up being quite a good start economically to the new year. I'll give an indication of this. If a bad outcome is when people are seeing their disposable income reduced by something like a sharp increase in the oil price, good outcome is obviously the opposite. And the yellow line on this graph, for example, shows you the rate at which people's incomes are growing in the US, which is, of course, the biggest and richest economy in the world. So this is the aggregate. It's not that everybody's real incomes are rising by more than 4%, but in aggregate, they are. And you can see as well that this has a very close relationship with GDP over a very long period of time, which is not surprising. So with the oil price benign, with wages growing, with employment expanding, actually we see economic growth accelerating at the beginning of this year. And that means better incomes for consumers. It means they can spend more in shops. And it also means they'll have more money going into their pensions each year, which is supportive for the market.
Okay. So if the Middle East situation remains contained, we still see other opportunities?
Yeah, absolutely. I think even though what we've been talking about so far has been a cycle, it's been the business cycle, but it wouldn't be accurate to describe all investments as following that same cycle. Now, the ideal investment that we're looking for, is one that has a strong secular uptrend. That means it's generally going to keep going up. But then typically you will have to think about your cyclical opportunity to participate in that. And a really great example of this is semiconductors. So semiconductors are the little switches that drive computers. They're likened, if you imagine the computers like a human being, then the semiconductors would be like the brain matter within that human being. So when we talk about secular trends, this is the best of them all, really. Do we expect to be using more computers for more things in the future? Yeah, we certainly do. Does that mean there's going to be a lot more semiconductors required? Oh, yeah, absolutely. And you can see this you can see the fluctuations around that trend in terms of semiconductor sales on this chart. Now, just a word on that. If you had bought into this particular secular trend at the worst possible time, mid 2000, obviously a bit of a tech bubble going on at the time, it would have taken you until 2016 before you'd drawn level, and you would have tripled your money, which sounds pretty good by now, but actually that's not a very good return over 25 years. But obviously what we're looking for here ideally is that cyclical entry point, and that's what we identified happening in the middle of 2023, so that now we are in that upswing. But we're still in the relatively early stages of it. Now, the drivers of that are similar to drivers of other cyclical markets. So, for example, if we recall when the pandemic struck, we were all stuck at home. Everybody changed their consumption patterns. They didn't go out to bars and restaurants as much. Instead, they bought products. What that means is the companies making those products were understocked, so they really ramped up production. And that then meant that when we came out of lockdown, suddenly they had all of this stock because they were anticipating really strong sales, but in fact people changed their consumption patterns again, and so they had excess stock, and that means they've got to produce less. It might mean they have to discount to get rid of some of this stuff, and it caused a bit of an overhang during 2023. And now I think really during that calendar year, we're getting to the end of that. So in general, most consumer goods markets are enjoying a bit of are getting to the end of that inventory cycle. Semiconductors had the same issues, that they came to the end of their cycle in around the middle of 2023. And in fact, I've got a chart that summarizes all of these positions. So you've got general consumer goods are at the bottom, at the nadir of that trough there. Semiconductors enjoying the upswing. The other market to watch, of course, is the one we've already talked about, which is oil. Oil is oversupplied at the moment. That's why the price is weak, but it's likely to move into balance over the course of this year, and that will give us an opportunity to participate in that, because again, there's a restricted supply, which should boost prices going forward. We can always find opportunities with the different cycles that are going on in different product markets, regardless of what's going on with the overall economy.
Thanks, Guy. That's really interesting. And it's particularly interesting to see the individual cycles of different markets and different opportunities within the larger cycle. So I'm glad that you guys are looking closely at that. Thank you for joining us. We hope you found that useful. If there are any questions following this video or any other subjects you'd like to see covered, then please do let us know. In the meantime, we hope to see you next time, and thank you for joining us for the Investment Coffee Break.